breaking down everyday workplace issues and diagnosing the hidden sickness, not just the obvious symptom. Our hosts, James and Kobe.
Did we lose a patient?
No, that's just my lunch.
Hey, thanks for joining us. I'm Kobe, he's James, and let's get started with a question. Does culture and performance increase a company's worth?
Okay, so this conversation is kind of building off the conversation that we had in our last episode about how stability can improve organizational investment. And so I want to restate a couple things. Again, of course, I'm avoiding answering the question outright, but that's been a trend for the last 3 seasons, so it shouldn't really be a surprise to anybody. But as I talked about a bit in our last conversation, we have a number of clients who have merger and acquisition as kind of a central component of their growth strategy. And so a significant number of our conversations recently have really focused around the role that company culture, stability, retention processes, these things have on the value of an organization. Now, at the same time, we've also been having conversations of similar nature with companies that are trying to prepare for investments, primarily around venture capital, but also nonprofits that are wanting to expand and grow their operations to capitalize on new or increased project funding. And these conversations have led to many, many discussions about the role that organizational culture, systems, and human capital strategy have on the value of a business from an investment or acquisition standpoint. So, today, what I want to explore with this question and with this conversation is really a bit about the business valuation ecosystem and whether or how we can incorporate a broader perspective beyond what's typically seen as just the financial bottom line.
Yeah, and I think something that will be kind of helpful too is that for you listening, this is hopefully going to be an interesting conversation if you're trying to better understand kind of the business case for
Yeah.
investing in culture and performance, especially if you're working in private companies. If you work in a company, or sorry, you work in a company or sector really that has a lot of acquisition and a lot of mergers, this could be very helpful to kind of understand kind of where you should be focusing your time and efforts and what the company should be prioritizing. So hopefully, even though it's, we're going to get into things like EBITDA and valuation and those kinds of that. Hopefully, we'll try and this will still be, fun and it'll still be kind of interesting for kind of broad strokes. But I really think that there's a lot to be gained from a perspective of um, looking at the different ways that a company can be evaluated and realizing that, spoiler alert, there is a value to a company's worth coming from culture and performance
Yeah.
that has a lot of versatility to it. So it's something that, understanding this, maybe even this language, could help you in your job if you are in a position where you're trying to kind of make cultural changes and trying to make the company put more value in human capital and potentially reinvesting in your culture and your performance metrics.
Yeah, I mean, being able, anytime you want to kind of shift the narrative or create a rationale for why a company should invest in something, attaching it to the bottom line, attaching it to the value of the company is a great way to do so. If Kobe, you mentioned, if you're in an industry with a lot of merger and acquisition, this conversation is going to focus primarily on the acquiree.
Mhm.
Um, but if you are in a situation similar to some of our clients that acquisitions is a key part of their growth strategy, there's still a lot of relevance here, but it's focusing on really understanding your own situation and measuring against your potential acquisitions.
Yeah, and so like you said in the intro, we've had some conversations and we've had clients that are in this space of, we're prepping to be bought.
Hmm.
And it's one of those things where, we've worked kind of and part of teams with companies that are aiming towards that. We have some of our own clients that have been doing that. And when, and even in your days in economic development, you saw a lot of that kind of stuff kind of happening, and
Mhm.
you were kind of on the side from the government supportive area. So this is something that we kind of like, we've seen a lot, over the years. But like we've seen conversations come up again just very, very recently. So we like to talk about stuff that's kind of top of mind for us, but also, maybe it's reflective of what's going on in the marketplace out there. But I think where I'm seeing flaws, and you're probably better to kind of correct my thoughts on some of these, is I'm seeing an over-reliance on the mentality of cutting costs and going lean
Yeah.
when people are kind of in the pre-acquisition, pre-being bought stage. And to me, I think that it's a bit problematic that that's kind of the go-to place to start for many founders and owners.
I don't think it's problematic that it's the place to start. I think it's problematic that it's the place they end. Um, because if you're looking, we need some sort of common measure, some common metric to evaluate a company against. And the one metric that you can compare across organizations, across industries, across different regions and countries is the financial health of the company, right? And typically expressed in EBITDA. Um, so using that type of metric as our base point makes a lot of sense, right? Because we want to know how much financial health the company is in, how much is left in the bank account after kind of our core expenses are taken care of. There should be more money left than money that we are spending. If you are spending more to deliver services than revenue that you're bringing in, that's not going to be a very valuable business, right? So you need to show that from an investment standpoint. The problem is many I say many. Um, I will say the business valuation consultants and people that I have encountered primarily focus on EBITDA as the sole expression of a company's value, or at least the dominant expression of a company's value. When really we need to figure out why the company is being acquired in the first place. If I overgeneralize in the situations that we've seen in the conversations that we've had, there's generally two big reasons why companies are being acquired. One, it's an asset acquisition, so there is some asset or set of assets that has value, whether it's physical buildings, whether it is a unique value proposition, a piece of technology or system or software that is creating the value. You can attach a dollar figure to that. Or there's being acquired to improve market share or increase market share, or there's some synergies there between the company that is looking to acquire and what the company that's being acquired does, right? So they're trying to expand to new markets or open up a new or increase their own market share or by acquiring competition. Generally speaking, those are the two situations that we see the most often. And the cost cutting kind of makes sense in the asset piece, right? You want to show the greatest amount of value overall. So you have a tangible asset that you can put a value on, and then you have the EBITDA, which is showing that the return on that investment of that asset is greater than the cost of acquiring that asset or running that asset. So that makes a lot of sense. And we see companies focusing on just the bottom line numbers in those types of conversations. The problem is when you shift gears towards an acquisition model that's not based on a singular set of tangible assets, but is more about acquiring a company to increase your market share, or to basically, as long if the company's not being stripped for parts and you're actually acquiring a company to continue doing what it has been successful doing, then you need to not just look at the financial performance, you need to look at what has gotten the company there. And 9 times out of 10, that's people. That's structure, that's stability, that is process, that is leadership. It's the leadership team, it's the founder, it's all of these other elements that talk to competitiveness, not just the revenue standpoint.
Right. So just to, take a bit of a step back, I just want to make sure that we're fully accessible to anyone listening to this episode. Can you just briefly describe what EBITDA is, and then
Oh,
just
yeah.
in case someone doesn't know?
Yeah, I'll probably mess up the acronym, but essentially it's your earnings before deductions, interest, taxes, depreciation, appreciate. I don't have
Amortization.
it right in front of me.
Yeah.
Yes. So EBITDA is a common metric to used to describe how much money is left in the company before you pay for your taxes and depreciation on assets and all of these other elements, other than like your core operational costs. So
Right.
you've got your total amount of revenue, you take out your core operational costs, what it costs to run the business, what you have left before you calculate your profit, which is money that's left after taxes and everything else. That's what your EBITDA is. So
Right.
it's less than your total revenue, it's more than your total profit,
Okay. All right.
generally speaking.
Yeah. No, that's just helpful. Just because, yeah, because again, just want to make sure that everyone
Yeah.
listening
And
is
the
fully.
reason why you look at EBITDA and not profit is because profit can vary significantly based on the tax implications, what region you're set up in, how your organization is structured, whether you are, registered within the country that you are operating in, or whether you have a registration in a more tax friendly situation. So EBITDA becomes a much easier standardization number to evaluate.
Right. And when EBIT is being calculated, it's usually being calculated with valuation multipliers, right?
Well, when
So,
you're calculating the value of a business, usually, yes. So the valuation is usually a multiplier of EBITDA
right.
based on a whole bunch of different factors, and those factors can change based on who is doing the valuation. But it's when you get to the idea when you hear, this company is worth X number of millions of dollars,
Mhm.
typically it has some sort of multiplier on their EBITDA. That's
Right.
generally where things come in. Now, depending on who's saying it, if it's the company themselves, they may be putting multipliers on their revenue instead of their EBITDA to make things sound really nice. But from an acquisition standpoint, from an actual business valuation for acquisition or investment, it's going to be based on EBITDA, not revenue.
Right. Okay. No, that's again, I think helpful clarity. Um, yeah, so but the reason why I kind of say I see problems with the kind of the cost cutting focus going to lean is that it is again, not that I necessarily think that that's a wrong thing in all situations. I think, okay, and you kind of spoke to it better saying that it's not it's more of if that's where they end and or stop, that's usually that can be problematic. But I mean, to me, the idea of the cost cutting going leaner, that approach to increasing your valuation numbers is that works in a really short term like sales timeline. Like when you have when someone's coming at you right now and you want to turn this around in 6 months, that kind of makes sense to me that people would do that. But I mean, but maybe not all businesses. Only if they're like, I guess you like I said, they're a competitor and they want to get you out of the market, or they're private equity and they like to carve up companies and
Yeah.
sell the parts. To me,
Yeah, if you're
that
being carved up for parts, then whatever, that's fine because you're not going to see the negative impact of your cuts anyways, and neither is the company that's acquiring you because they're going to chop it up for all the and take all the value out of the company anyways. You're right. It is a short-term mentality.
Mhm.
Basically, if you can sell and get out before the impact of your cuts are show on your bottom line, you're okay. It's not depending. Well, I'm not going to get into motivations because I'm not going to speak for other people.
Yeah.
Um, I don't see it as the most effective way of showing value in a company.
Mhm.
Um, and honestly, I haven't seen now. I will preface this by saying I've not handled a massive amount of acquisitions or business valuations, but the ones that I have seen typically take significantly longer than 6 months, right?
Right.
The lead up time to it from the time that you identify a potential investor or identify that you are ready to exit your business to the point of actually signing on the dotted line and all of the due diligence that takes place between that initiation and that actual sale, there's a lot there. And
Yeah.
there's a lot of any investor with half a brain is going to do their due diligence, right?
Right.
So if you have made cuts to boost your EBITDA as a share of earnings, in a strict method of trying to raise your business valuation, that's gonna come out in the due diligence unless you are able to move exceptionally quickly.
Right. So, because when companies kind of come to us, is usually because they've decided to not take that approach. Usually, it's because they're like, okay, we've got a longer term exit plan, a year, 2 years,
Yeah,
3 years, even, and they want to sell the business growth opportunities.
yeah, yeah,
They want to be at a much more profitable, hyper performing piece in order to increase valuation. And they're looking to be bought out by someone that's not going to carve them for parts, someone that's going to utilize the assets of the company and kind of be good for the company under the new ownership or whatever like that. And to me, again, that makes more sense to me from both a valuation standpoint, but also just kind of a sustainability standpoint. Because the way I kind of see it, and again, I see it in very simple terms sometimes, because again, this is more your area than mine. But to me, it's like the cost cutting is versus the kind of the investment in increased performance and increase and growing the company before sale is kind of like when you're selling your house. You get like cracks and mold in your ceiling, but like you have a quick turnaround time, so you just slap a coat of paint on it. And because by the time the paint dries, they come in, they view it, you sell it before the mold comes through the paint or the cracks show up
yeah,
again, right? Versus investing in performance is actually fixing those pieces, putting the stuff, dropping in 30K to add another 100K to your sale price. That type of longer term, but like more
yeah.
sustainable, not covering up the the cracks and the problems, but fixing them so that way it's a stronger, better opportunity for the purchaser. And to me, that's kind of how I see it. Again, it's in
Yeah,
simpler
no,
terms.
it's not a bad analogy because just as in real estate, there are some things that you can invest in that are going to add significant value to your home, and there are some things that you can invest in that are going to add very little in actual monetary improvement or return on that investment to the sale of your home. The same is true in our businesses as well. And I understand how people why sometimes we forget the people component and the process component and this structure component and the growth component because it's very common to hear that investors don't pay for potential, which is true, right? They're
Mhm.
not. If I if we wanted to sell our business currently and we went to somebody and said, you know what? We've been doing all of these great things in this market, and we've identified this really substantial another market that, if you get into there, you can, increase revenue, 15x.
Mhm.
Great. All we've done is identified an opportunity. All we've done is identified potential. But
Yeah.
if we take the time, we identify that potential and we take the time to actually create a foothold in there, create some stability in that new market and show success in that market and that we
Mhm.
can actually capitalize on, that is a fundamentally different conversation. right? So this is what we often see is the language of investors don't invest in potential being used as an excuse not to invest in yourself to put your company in a better situation than where you are currently,
Right.
increasing your market share or opening up creating a foothold in a new market is an incredible conversation to have with an investor rather than here's this great opportunity to here's what we've done so far, here's the market size, here's the strategy that we used to show improvement and gains in that market.
Right. Well, and that's just it, is that like, I mean, like the cons of the performance of investing in performance and investing in growing the company before sale is that it can reduce short-term profits if you're actually, putting the investments in. And you have to like carefully document kind of the story for
Yes.
the investors. But the thing is that but investments are valuable if they're visible and they're de-risked, right? But I mean, if you show metrics around the traction you've achieved, like, revenue per employee, or like your efficiency gains, or the new or the year-over-year increase of sales, or the launches of new products, and the foothold and the projected momentum, right? Plus, you actually kind of show if you really make it clear how the investments you're making now are going to show off, or sorry, pay off
Mhm.
and be seen in the post sale, so that way the investors can reap the benefits that are going to be coming. But a lot of that is about kind of having your processes, your systems, everything that's documented, that's clear. That's the stability that we talked about kind of in our last episode, right? They want to make sure that you are set up to scale, and that your scalability is clear and it's transferable to the buyers once they take over, that it will continue on afterwards, right? So part of that is making sure that the performance and culture is ingrained into the operations, and you operationalize all this kind of stuff, because that's going to be how it's going to continue paying off post sale.
Yeah, I mean, we need to understand what makes a business attractive for investment. And this is a
Hmm.
conversation when I was in the economic development role. I worked primarily with small businesses and, helping them. A big part of that was succession planning and helping them to actually sell their business, or valuation was a big component of that. And people invest the businesses that have the greatest um, return on investment, or the businesses that have the most value, are ones that do not require the founder or the owner or the purchaser to be involved in the day to day.
Right.
So with small businesses, we see this struggle a lot where there's still so much resting on one person or one or two key people. We last episode we talked about the technical founder paradox, and we talked about linchpins, and we talked about all of these elements. So I'm not going to rehash that entire conversation,
Hmm.
but it's really important to understand that most people who are buying a business or acquiring a business, most of them are not looking to buy a job, right? There are some
Hmm.
who will purchase a business so that they can work in it and lead it at the same time. But largely, people are looking for it as an investment. They're either going to absorb the business into their current operations if they are a competitor and help to grow that piece, maybe even under your same brand, maybe not. But if the success of the company still rests on one or two people, if it requires them to do an awful lot of the day-to-day work, it's far less attractive to them than if you have a robust leadership team that knows how to work together and, within their own responsibilities, but also being able to collaborate and not creating silos. Management teams that understand how to motivate employees, and structures that allow for people to be know what is expected of them, live up to those expectations through performance frameworks and accountability frameworks. The more structure we have in place that provides that stability, that provides the consistency in expectations and outcomes, the more attractive that becomes as an investment for somebody else. Because it means that all I need to do if I am buying this, if I am acquiring this business, is I can be the visionary leader who sets the goals, sets the targets, sets the expectations, and the leadership team is effective and understands how to take that vision casting and operationalize it. And they know how to disseminate that to the managers. Managers know how to disseminate that to the employees, and everybody is working towards the same goals. That's vastly different than what we see many companies and the situations that they are in.
Well, and the thing that I always kind of come back to whenever we get into these conversations is that the performance management systems, the operationalizing, the kind of culture and human capital elements, the improving performance and improving output, and again ingraining the scalability
Mhm.
into the culture and into the operations, right down to like how policies are designed. They're designed to be scaled. They're designed for scalability. That justifies higher multipliers when it comes to evaluation because it's about the growth potential and the transferability of the performance of that higher output of the greater outcomes of that scalability into the company's value, right? Because the idea of is that if your company hasn't operationalized its culture and its human capital strategy, and you have a great leader and you have a great leadership team and they're all doing great, very, very, very well, then a lot of them probably leave post sale. So it tends to be something that kind of commonly happens. That if they're the only thing propping up that performance, propping up that customer experience generates higher sales or whatever it is, that ends up kind of not being transferable
Mhm.
to the new owners. And then, and that evaluation piece isn't much there. But if that stuff is internalized and operationalized into the way the organization is structured, it's built with intention and strategic intent for scalability, for higher performance, without a major intervention from the purchaser, that increases the multipliers when you're looking at evaluation because it's about growth and it's about transferability.
Yeah, and one thing that we haven't, which is odd for us, we haven't really talked about the employees yet.
Right.
And what came up for me kind of as you were talking is that think about so oftentimes the potential when a company is getting ready to sell, whether it's the founder is exiting or whatever the circumstances that led to it, oftentimes that's kept under wraps
Right.
because what you don't want is for all of your talent to run out the door because of the scarcity mindset. This idea
Mhm.
that, well, the company's going under or they're just going to get their payday and we're going to get stripped for parts. And so I need to find something else, right? So oftentimes there's a level of secrecy to this, and confidentiality is a good thing. I'm
Yeah.
not saying it's not. But let's compare the perception of those two primary conversations of we're going to cut costs to increase EBITDA versus we are going to invest in stability to increase valuation,
Right.
right? From an employee perspective, one is well, they're cutting costs, so I need to protect myself and my family. So the first people out the door are going to be your top performance because the
Yep.
top performers in your organization have more opportunities to get better jobs than the poor performers in your organization do.
Yeah.
Pretty basic
Yep.
set of facts. The
Mhm.
other conversation though, if people know that the central value that how the company is being sold and evaluated and valued is based on not just the assets that the company has or not just the financial bottom line multiplier, but the people contributing to that are valued as well, then it's more likely that the perception will be, well, the whomever is they're buying this company because of us. It's unlikely that they're going to step in and clean house,
Right.
right? Usually they'll probably get rid of some or much of the leadership team because that often happens. You often,
Mhm.
especially if this is a regular occurrence for a company, they will have leadership teams that they will want to parachute into so that the newly acquired company can be integrated with the parent company's culture and everything else that's going on. But it's not a given, right? And it doesn't have to go further than that and it protects your top performers.
Right. Well, and the thing is that, and we saw this with a client recently. They didn't sell the whole company, but they sold a massive department.
Hmm.
And it was because of the people. I mean, there certainly were a lot of assets and a lot of resources within this department, but the thing was that the company sold this really important big part of their business because of how high performing the team was, because of the outputs, because of the customer experience, all of this kind of stuff that we're talking about made that division or that department so valuable, and that it was being it was to being really looked at by competitors. But what was interesting was, again, part of what you're kind of saying too is that making the acquisition making the acquisition process not scary or not, like secret of in a sense, but almost like this is something that's happening, but we are taking care of you even,
Yeah.
when you're gone. We're going to make sure that part of that you're, that
Yeah.
there's,
I
you
still
know,
wouldn't announce to your entire staff that
no,
you're planning to sell the business. I mean,
no,
there's a time and place for that
absolutely.
conversation to happen.
Yeah.
But yeah, I mean, when you get companies, no matter how big they
Mhm.
are just they're comprised of small communities.
That's right.
And no matter how hard you try to keep a lid on things, rumors are going to start flying.
Hmm.
As soon like it's inevitable unless you have a very, very tight leash as a owner. I haven't seen it.
Right.
I haven't seen it yet.
Mhm.
Maybe someday.
Right.
But in the absence of information, people will fill in the blanks themselves. So you at some point you do need to get ahead of the narrative. And if that narrative is no, our employees are central to the value of our business,
Hmm.
that places them at that places a much different perception in people's minds than the reverse.
Right. Absolutely. And again, in cases like we talked about recently, where that division was sold, it was sold because of the people, but it was also sold
Yes.
because of the processes. It was sold because of the systems in place that were transferable to the new owner. The new owner wanted that success and to prop up and augment what they were
Yeah.
already doing. And that made it an exceptionally
They
valuable.
wanted the asset of that department, but it was also the people in that department. And honestly, let's be real, it was the leader in that department
Mhm.
who had put many of these pieces in place that
Yeah.
had created an incredibly effective team that
Mhm.
turned that from an asset acquisition into integrating these people into the core operations of this of the larger division, larger company so that
Mhm.
they could take those best practices that had been developed, which is also an asset,
Yes.
and deploy that throughout the organization, right? They
Yeah.
saw not only physical, tangible assets that had value, they saw
Mhm.
people that had tremendous value in making those assets valuable.
But I think you touched on something that I think is just worth repeating, that the best practices, the systems, the structures, the protocols, those are assets that are transferable to the new owners when they don't live in just the mind of a leadership
Yes.
team or an individual. When you operationalize those processes, those systems, those best practices, that performance structure, then that is a transferable asset that again creates the multiplier. right?
Hmm.
And that's something that I think is completely missed when we are looking at the cost cutting approach over the performance investment approach, right? Because I mean, like, because the thing is that if you have two companies that are like you compare two companies that have maybe a similar sales timeline, similar industries, and maybe have the same like EBITDA.
Maybe they're competitors in the same marketplace.
Yeah,
Yeah.
but I mean, if one of them is cutting costs, then it's going to basically it can flatten the multiple of their valuation, right? Whereas when you add these assets like the best practices and like the systems and you're talking about growth metrics, that will increase more multipliers. So a company will end up have will end up be will instead of having maybe a 4 times multiplier, it may have a 5 or 6 times multiplier,
Yeah.
right? Same where so just the company's worth more because of the additional growth metrics and the additional assets that exist.
I think it's worth mentioning as well that we need to think about the perception that cost cutting sends to an investor.
Right. Yeah, that's true too.
Because if you slash $250,000 off of your expenses, that's coming from somewheres. It's
Yeah,
either coming from staffing, it's coming from marketing, it's coming from, I don't know, wherever you're that money is not just magically appearing.
right.
It's being taken from somewheres else.
Hmm.
When do businesses cut costs? When they are in trouble. When
Right.
we are like we've seen it over the last couple of years. Well, we've seen many cycles of recessionary cutting
Yeah.
over the last number of years, far too many cycles of it for my liking.
Hmm.
But think about when businesses tend to cut costs. What's amazing to me is that when a business is in trouble, often the first place they start to cut costs is around marketing. So you're not able to your revenues have dropped, so let's cut the division that's responsible for helping to attract new clients, right? Anyways, the
Right.
mentality doesn't work out, but the perception is there regardless of your intent in doing it. Your intent might just be, oh, we've been able to move a few things around and show some improvements, and we want to show the improvement in EBITDA. But when I do my due diligence and I look at historical spending, and I start to question, well, why either I'm identifying that you've artificially made cuts to increase your EBITDA and therefore artificially inflate the value of your company, or I'm looking at that and going, what's happening within this business that is forcing you to make cuts rather than making investments? We
Hmm.
invest when things are good, we cut when things are bad.
Right. Yeah. No, and that's a fair point. And yeah, so like again, I don't want to like I'm I I acknowledge I have a bit of bias away from the cost cutting just because again it's mostly
Well, I
because
mean, looking at what our our
yeah
entire
yeah
focus is on people, so it's not a surprise that we
yeah
are biased in one direction.
yeah but to me I think the reason why I am so much more like, like, or why we really try and bring the showing the value of performance investments into to our clients when we're talking about acquisitions is partly is because I think that with the cost cutting it creates false positives when done when kind of like you just talked about, but also like I say but it flattens the valuation, like your multiples become flatter,
Yeah.
right? So it is like again, and if you do it too soon, like you were saying earlier on, then the side effects of the cuts start coming out, and like the stability starts to weaken because took a chunk out of the value of the organization, and that came from somewhere, likely came from people, or likely came
Yeah.
from
If you
stuff that is
pulled $250,000 out of your $300,000 marketing budget
yeah
in order to show an improvement in your EBITDA, and that sale does not go through quickly,
Yeah.
Your investors are and your clients are going to see a dramatic shift in your revenue over time.
Yeah. So I just think that so again, so there was a real lack of sustainability to cost cutting that really I can only see it in really short sales cycles.
Yeah.
But I also kind of like again, I'm trying not to say also that it's also a bit shady. I'm trying not to go there, but I'm kind
But you
of
just went there. You just stated
yeah,
it. Yeah.
yeah, I
So you might
know.
as well lean into it now.
Yeah, you're right. It does seem more, it's at least ripe with opportunities for it to be shady,
Mhm.
to be the most generous, right? Whereas when a company is going, okay, so we're going to sell in 2 to 3 years, so we're going to, invest 100K to make a million or whatever, like kind of
Yep.
whatever that again increasing to the growth metrics that you can so you're positioning for growth, you're positioning for transferability, you're positioning for more operational structures that will show again continued success post sale when largely when you're investing in scalability, sustainable stable scalability, that has the ability to really add to the multiples that you need
Yep.
for your valuation to go up. You're worth more when you have that kind of investment in that sustainable, stable scalability. And to me, that is so clear and it's something that, again, it's less shady too. But I really do think that this is something that, we need to be really again, as businesses, we need to be really trying to focus on what is going to be the best thing for us in the medium term and long term and not looking at the short term pieces. Because really, I really do kind of think it is that if you're planning to sell soon, within a year, I can kind of get behind the going leaner and to maximize your EBITDA. But again, still seems a little bit there's your shadiness there. But if you're again a year to 3 years out, invest in sustainable performance gains because those are going to reduce your risk and improve your scalability and increase your valuation.
Well, and if you invest in building the structures and the supports and maybe it's investing in getting a foothold in a new market. Maybe it's investing in, whatever that investment is. There's no guarantees that you're going to be acquired. You may put it out there.
Mhm.
So, do you want to be left with a organization that has been stripped already by yourself and be unable to sell it? Or do you want to be left with an organization that is designed for growth?
Yeah. And so again, like going back to you listening, if you're in a position where you work in a company that maybe doesn't invest in its performance structures, in its culture, in operationalizing kind of the human capital element to it, or doesn't have the systems or processes and those kind of things, this conversation about again about valuation, about acquisition opportunities is something that really could be a helpful thing for you to have in your back pocket when you're trying to promote, excuse me, promote that we should be investing in these things. That operationalizing our performance structure, creating, again, more growth metrics is something that can be done that has a very high ROI, especially if you're in a company or industry with a high amounts of acquisitions.
Yep.
And it's something that, again, like stable scalability is something that we really we talk about a lot with our clients and in our work because I mean it's kind of a cornerstone of the work that we do. Part of our assessment tools, part of our structural pieces. When we go in, this is usually what we're trying to do. We grade organizations on their ability to operationalize stuff and how well they're doing with scalability. And we see the success that comes when they do that. But it's one of those things where there's a huge mindset shift that has to happen
Mhm.
for that to become as normal as we would like it, but as normal, I think, as those that are looking at the bottom line would like it.
Yeah. I think the only thing that I'll say, I'll re-say because we've both said it several times already, but once again, we are talking about short-term versus long-term strategy
Right.
or lack of strategy versus actual strategy.
Yeah.
And we talk about this mindset in so many different areas because plan beats no plan.
Mhm.
And strategy, we need the time scale of business. Yes, we have to be looking at what are we doing this quarter, next quarter, and into the future. But we also need to take a step back, broaden our view a little bit so we can look at where do we actually want to go so
Mhm.
that those quarterly metrics, those annual metrics are actually in service of a larger vision, of a larger strategy. We need to take a longer view and
Mhm.
stop being so reactive.
No, that's good. Yeah, I don't really know if I've got anything better like I can say than that for the summary. That's pretty good. Yeah.
Okay.
So,
I
yeah,
noticed. That's why I said
yeah, great.
it.
All right. But yeah, so I just think that again, if organizations really want to, again, going back to the question, does culture and performance increase a company's worth? It
Yes.
does if you're trying to look at increasing the multiples that will be assessed with your growth opportunities. And that's something that, will also make a higher appeal to, or so you'll have a more broader appeal to more companies.
Yep.
Because, again, only in the ideas of your just short-term sales to maybe to competitors or to private equity that might work with cost cutting, but beyond that, it's investing in your performance and your culture that's going to be what increases the evaluation of your company and your worth, right? So, all right. So that does it for us. For a full archive of the podcast and access the video version hosted on our YouTube channel, visit roman3.ca/podcast. Thanks for joining us.
For more information on topics like these, don't forget to visit us at roman3.ca. Side effects of this podcast may include improved retention, high productivity, increased market share, employees breaking out in spontaneous dance, dry mouth, aversion to the sound of James's voice, desire to find a better podcast.